everyone, welcome back to the show. Thanks for tuning in. My name is Mike. This is my whiteboard. Hopefully everyone had a great weekend. And today we're going to ease back into it. We're going to talk about cost basis reduction. So it's a term that you hear all the time on even on dough when you're looking at follow trades. People are talking about reducing their cost basis. So today we're going to talk about just the theory behind that and how that plays into options trading, the way we trade options at So there's a few things that I like to consider when I'm thinking about cost basis reduction, and we'll get to those on the very first slide here. So the first three things that I think are key to keep in mind when thinking of cost basis reduction are listed here. So why should we think this way? First and foremost is market uncertainty. I never know what's going to happen in the market. Yes, I can have an assumption, but not all the time I'm going to be correct. And even if I am correct, for certain strategies, I need to be correct in a certain amount of time, etc., etc., etc. So when we're looking at cost basis reduction, the key is market uncertainty, and the fact that we don't have a certainty and we're uncertain of what might happen in the market, cost basis reduction is something that we can use to offset that. Secondly, when we're looking at cost basis reduction and just reducing our cost of trade entry, we're inherently increasing our probability of profit. And I'll start to talk about that a little bit on the next few slides here when we look at some examples of how we can reduce our cost basis continually. Which brings me to my last statement here, and the fact that it's a sustainable mindset. If I'm continually reducing my cost basis, I'm able to continually put myself in an increased probability of profit scenario, and I'm continually able to take this market uncertainty and put myself in a better and better position. The lower I can reduce my cost basis, the better. If I can eventually own 100 shares of stock for a cost basis of 0 because I've collected so much premium over time and I'm able to offset that cost, then that puts me in a fantastic scenario to be profitable, as you can imagine. So when we're talking about cost basis, we're really comparing one trade to another, but specifically I like to start with comparing a short put or any other strategy that involves collecting premium to just buying shares outright. So that's what we're going to start with on the next slide. We're going to be looking at just buying shares outright, and we're going to look at the cost basis associated with that, and then we're going to compare it to a premium selling strategy, and we'll talk about the benefits of each. So we've got 100 shares of stock here, and if we're looking at a stock trading at $50, that's going to give us a cost basis of $5,000. As you can see, this cost basis bar is completely filled in because of the fact that if I'm just going out into the market and I'm buying shares, I'm not giving myself any leeway and I'm not reducing my cost basis in any way. It's just a traditional transaction. So I'm taking those $5,000, I'm going out, I'm buying 100 shares of stock at a stock that's trading at $50. So I don't have any benefit and I don't have any con when it comes to the cost basis. Nothing's hurting me, nothing's helping me. It just is what it is when I'm just buying shares of stock. So what I can do instead is, as you know, one popular strategy on to get into stock or get long stock by the way of a short put. So what we can do is we can sell a put instead of just buying the shares outright, and we can collect a credit in doing so and reduce our cost basis overall. So if we compare these two strategies, this strategy up here, my cost basis is going to be $5,000, and that's simply because of the fact that I'm just going out and buying 100 shares at $50, which equates to $5,000. Here though, my cost basis is a little bit different. So I've got two different scenarios that can happen. Number one is if my shares are put to me, then my cost basis is going to be $4,600. Now how did I calculate that so quickly? Well, really all I need to know is that if my stock price goes below my strike price, in which case my strike price is 47 in this example, then that would mean that I would be put shares at 47, or that would give me a cost basis of $4,700. But because I'm selling this put for $1 credit, I can use that credit to reduce my cost basis even further. So if I put the shares at 47, because if I'm selling a put, I'm selling the right for someone else to sell their shares to me, and I'm able to use that $1 credit to further reduce my cost basis, then that would bring my cost basis down to $4,600. So now if you compare the two strategies and compare what would happen in terms of P&L, if I were to have purchased shares here at 50 and the stock price went down to 46, I would be at a loss of $400 on this trade. Whereas if I were to have just sold that put at 47 and collected $1 in doing so, and the stock price went down to 46, I would have a P&L of 0. I would be breaking even if that same exact move happened when I compare these two strategies. Now, of course, if I were to have purchased shares outright and the stock price went up, I would have unlimited upside. But in selling premium and giving ourselves the cost basis reduction effect and giving ourselves a higher probability of success in this strategy here, of course, I can only profit to the tune of $100 because I'm selling premium and I'm selling this put. And when I'm selling that put naked, the most profitable position is when I'm going to be able to have that put expire worthless, which would let me collect and keep that premium, and the position would just disappear. But when we're taking away the home run and we're effectively reducing our max profit to increase our probability of profit, then this strategy is the one I would go with when I'm looking at cost basis. But let's say that I did go ahead and choose this strategy because of the things we just talked about, but I'm looking for different ways to further reduce my cost basis down the road. So on the next slide here, we're going to look at another thing that we can do with puts in this specific example. So what happens if the stock price actually does move down? Well, if I know that I originally collected a credit here and the stock price is well below my strike price, so let's say it drops down to 46 like we said. Well, what I can do is allow myself to be put that stock. So now I would own the shares at 47, which is why I've got this dotted line here. So now what can I do? Well, if I'm long 100 shares, I can sell a call against those shares and I can take on no additional risk. If I already own the shares and I sell a call, the brokerage does not require any additional margin on that trade because I already own the shares and I would be selling a call and it would create a covered call scenario. It's designed and called a covered call because of the fact that I'm long those shares and I'm not selling a naked call. Because I'm long those shares, it is considered to be a covered call. So I can just sell premium here, cap my upside again, sell it for another 60 cents and reduce my cost basis even further. So let's say in this specific example, I'm selling a 51 call. So I went $1 higher than where the stock was originally trading, and I'm able to collect a pretty decent credit for selling a call this far out of the money. So now the best case scenario is, number one, if the stock price does in fact move back up, because I'm going to be able to see profit on that position where I'm long stock down here at 47, even though my current cost basis is at 46, and I'm able to collect additional premium. So even if the stock price doesn't move at all, my cost basis at expiration, if I'm able to keep this 60 cents of credit, is going to move from 46 down to 45.40. I'm just taking that credit and subtracting it even more. So as you can see, the more and more credit I collect against my shares here, it's going to put me in a better scenario and reduce my cost basis over time, which basically allows me to profit even if the stock price doesn't move. So now if we compare the original strategy of buying 100 shares of stock at the 50 strike price, what do we have? Well, if the stock price does end up coming back up to 50, and I can take into consideration that I've collected this additional credit here, on my original trade, if I would have just purchased those shares outright, I would be breaking even. I would have purchased those shares at 50, I would have seen it go down to 46, and then come back up to 50. So I would have seen losses, and I would have recouped those losses just by doing nothing. But what would I be at in this scenario? Well, if I know that my cost basis is actually down to 45.40 and the stock price comes back up to 50, I would take the difference there of $4.60 or $460, and that would be my profit. So in a situation where the stock price was at 50, went all the way down to 46 and came back up, if I were to have chosen the strategy that reduced my cost basis and gave me a better situation from the get-go, I would actually be profitable compared to just buying shares outright. So this is why we harp on cost basis reduction so much, but I'm going to show you another step that we can take even if this position goes up back here. So on the next slide, we're going to be looking at what we can do if maybe implied volatility is increased a little bit. So let's say the stock price did come back up to 50. So as you know, in the previous example, this was our last strategy that we deployed. We sold a call against our shares for 60 cents of credit. But now I'm really liking what this stock is doing. I like that it's kind of moving back and forth in this small range, and I want to get long even more shares. So what's a situation that I can use to go ahead and do that? Well, maybe one thing would be to sell a strangle. So I'm already long shares at 47, and what I can do is instead of just selling another put, let's say that my 51 call expired completely worthless because we stated that the stock price went up to 50. So let's say this call expired worthless and we were able to keep that 60 cents of credit. Well, now what can I do? I'm long 100 shares. I've got no options there, but I want to continue to reduce my cost basis, and I want to potentially get long 100 more shares. So for me, maybe I would choose something like laying on a strangle on top of those shares that I already own. So what might it look like? Well, maybe I'll sell another put on my 47 strike, and let's say I'll move my call up just a little bit to keep an equidistant zone of profitability for this stock price to move. So let's say I sell another put on the 47 strike, and I sell a call on the 53 strike, and I'm able to collect a $2 credit now because, as I said, let's say implied volatility is increased, which basically reflects the option prices. So if I know implied volatility has increased, that must mean that the option prices are they have a lot more premium than they would have in the prior examples. So let's say I'm able to collect a whopping $2 for this now. So best case scenario is that the stock price stays somewhere in between this range. Since I'm already long the stock, I would love it if the stock price went all the way up to 53. If it didn't breach 53, both of these options would expire worthless. Since I'm selling just out of the money options here against my long shares, I would be able to keep that $2 credit and reduce my cost basis even further. But even if the stock price goes back down, I'm able to get long another 100 shares. I'm not just buying shares outright in the market, and my cost basis is going to continually drop and be dropped as I continue to sell premium. So as you can see with these bars here, we started with the stock price being at 50 and we were looking at just buying shares outright in the market. The cost basis bar was completely full, but instead of going that route, we decided to use options as a way to effectively reduce our cost basis and increase our probability of success. So the more we sell premium against our options and take on a little more risk and reduce our max profit overall and take away the unlimited profitability, we're able to reduce our cost basis lower and lower and lower. If I'm able to do this over and over and I'm able to maneuver these strikes successfully and continually reduce my cost basis, I can effectively own shares with cost basis close to zero. Of course, it would take a long time to do that, but that would be the goal. For me, the goal is to own shares outright for free rather than purchasing them out in the market. And we can do that by using strategies like this, which increase our probability of success over time. The lower I can move this bar, the better off I'm going to be, because that allows me to be profitable in situations of non-movement, especially when we're talking about options, or like the original example where we had the stock price at 50, drop down to 46, and come back up. If I were to have purchased shares at 50, I would be at break even, a P&L of 0, but since I looked at the option strategies where I would have gotten long at a much lower price, that would have actually given me a profit. So let's wrap all this together with some takeaways here. So I compiled all the information for these trades, and in just a few trades, we would have been able to reduce our basis by $3.60, or $360. So in just a couple of trades, I would have been able to collect $360 just by pretty much doing nothing. I'm just holding that position, holding the risk, along with the shares that I was put, and I was able to reduce my basis by $3.60. However, if I was put all the shares, I would be able to be long 200 shares at $45.20 instead of just buying shares outright in the market of $50. So I'm actually reducing my cost basis much lower. Here I'm collecting $360, but because I have the ability and benefit of strike selection, my cost basis is actually going to be much lower because I was selling out of the money options. I wasn't selling at the money options. So here, I would be able to be long shares at 200, because if you remember, I was long 100 shares at 46, then I sold another call against it. That brought it down to 45.40. And then if I were put the extra 100 shares that I created with that strangle strategy, my cost basis would be at 45. So the difference between 45.40 and 4,500 would just be 45.20, which is where we get that figure here. And this last quote is a great one to consider when we're thinking about how to really internalize cost basis reduction. So you can't control the wind, but you can adjust your sails. So for all you sailors out there, anyone familiar with boats and how that works, if we're not using cost basis reduction or option strategies, we basically have a sailboat with a non-adjustable sail. We're not allowing ourselves the ability to maneuver and optimize our trading. We're just putting ourselves out there and letting the wind take us where it will. So using options, specifically with cost basis reduction, not only gives us a better probability of success, but it also lowers our cost basis, which allows us to not worry about things we can't control and really just focus in on and improving the things that we can. And the best thing that we can control is our cost basis, which is why you see us reverting back to selling premium over and over. So thanks so much for tuning in. This has been Cost Basis Reduction. If you've got any questions or feedback, shoot it to one of these emails here, or you can shoot me a tweet at. We've got Jim Schultz coming up next though, so stay tuned. Hey everyone, thanks for watching our video.
If you liked this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.